Okay, so welcome back to the desk. We're going to move on now to our next exogenous driver. We're going to be looking at the balance of payments and a bespoke trade analysis of Australia. And things in this video can get pretty complex, and there's a lot of information to take in. So the best advice I can give here is to actually just get into the spreadsheets and try to reverse engineer the spreadsheets and see where all of the data is coming from, and try to replicate the spreadsheets and build your own. Understand how they've been built and understand how the data is interpreted. The first thing we're going to look at in the balance of payments is we're going to be looking at global foreign exchange reserves, both for the Australian dollar and the US dollar. And we're going to be then looking at the global FX reserves for the Aussie dollar and the US dollar relative to each other. And this basically gives us an historical precedent in which we can base our scoring system on when we move on to build our bespoke trade analysis of Australia itself. So again, in this situation, in the exogenous build out, we're looking at Aussie dollar, US dollar as our proxy, and we're building an analysis where we're measuring the Australian economy relative to the United States economy, and then using the Aussie dollar as a proxy to determine our view. And we're building up the scorecards to determine whether we should be having a short or long bias in the Australian dollar, US dollar exchange rate, and working again on a dynamic relativity principle. So the first thing we do is we build out a balance of payments analysis, and what we're really looking for here is the gap within the balance of payments. So the gap in foreign exchange reserves and what we call the balancing item. So this will all become clear as we go through the whole analysis, and we get a historical precedent in order to build out our scorecards. Our scorecards are built on the basis of the historical precedent for Australia relative to the United States, and on the basis of the gap in the balance of payments, so the principles that we get from studying the gap in the balance of payments and FX reserves historically, and applying this to the current and future possibility of export and import gaps in Australian trade. And then we determine from the scorecard our short or long bias in the Aussie dollar, US dollar exchange rate. Now, as I said, things can get a bit complicated here, but it's okay. Just go through it as many times as you can. You know, this is the beauty of a video series, in that you can rewind and just keep going through things until you fully understand it. And also practice a lot with this spreadsheet, because the spreadsheets are complicated. Probably the most complicated in the video series, along with the statistical distributions that we did in Foundation when looking at volatility. But again, just keep going through it and try to take your time and understand how all these principles and interpretation comes from the data. Probably the most important principle here is the principle of money flow. Money flow being the debits and credits system of international trade. So exports and imports, and money flow being the opposite of exports and imports. So you have to try and get a handle on picking up what the money flow is in each scenario. So when you understand it and you have that foundation of understanding, you can actually connect the dots very quickly when you see certain data points in exports and imports, the balance of payments, and within your own trade analysis. So go through the video as many times as you need to. It can get a bit complex. Practice the spreadsheets, really try to understand the underpinnings of money flow. That's the most important thing. Okay, so let's go over to the computer screen, and I'll see you at the end of the video for a recap on balance of payments and trade analysis. Okay, so welcome back to the computer screen. We're going to crack on now with scorecard 8 in our exogenous analysis. We're going to be looking at the balance of payments and trade, and we're going to be analyzing a lot of data in this section, and things can get a little bit complicated, but we have to just stick at it here and learn these things as we go through and learn this through immersion. So what we're going to be doing is comparing two countries or economic zones and comparing their balance of payments relative to each other, and we're going to be doing a bespoke trade analysis as well. And as just previously mentioned, when we're analyzing the balance of payments across two countries, things can get very complicated, but we just have to build things out slowly. Understanding these things in theory is just not enough. We have to understand it in theory and learn how it really applies to the real world. So what you're going to see online is a lot of theory on balance of payments and how this affects the value of a currency pair. The problem is that it's far too basic an analysis. It doesn't go deep enough to really understand the underpinnings of how these things are correlated. So here we're actually going to apply the theory that's out there that you can get hold of from a textbook at university or online on various basic Forex websites. But these guys never explain how it really applies in the real world. So we're going to apply it here and properly work it out. And the best place to start, really to start building this out, is start really understanding how the debits and credits system works for a balance of payments. So let's look at the basics. Everything in balance of payments is based on a debits and credits system. And if a country receives goods, we just have to remember that they have to pay for it. So this is a money outflow from the country. And the opposite holds true. So basically, if a country exports goods, they're sending goods abroad, the rest of the world has to pay for those goods. So that's money coming into the country. And this is really key to our understanding this principle, how the balance of payments works. We need to understand the flow of money and keep this in the back of our minds all the time. So always keep in the back of your mind as we're going through things here that it's a debit and credit system. And the debits and credit system, the flow of money, is the opposite of what's actually recorded in the balance of payments for a country. So keep that principle in the back of your mind as we're going through things. First, we're just going to define exactly what we're looking at. And much earlier on in the video series, in Foundation, we introduced you to the balance of payments and the current account balance as part of that, with the capital account, the financial account, and the balancing item. Now, a country's balance of payments is the sum of all these parts. So the current account balance plus the capital account plus the financial account plus the balancing item. And the current account balance is exports minus imports plus net income from abroad plus net current transfers. Now we're going to go one step further than what we focused on earlier in the video series. We focused earlier on the current account balance. We're now going to focus on the entire balance of payments equation. So we'll be looking at the current account balance and the capital account in both its narrow and its wider form. So the capital account is generically known as the capital account in its narrow form. So when you hear somebody mention in the press, in the media, about the capital account, if they say capital account, what they mean is the capital account in its narrow form. In its wider form, it's also known as the capital account, but it includes the financial account. So by definition, by the equation that we're looking at, the wider form of the capital account is the capital account plus the financial account. And in theory, the current account balance, the CAB, and the capital account in its widest form, the CA, so including the financial account, should equal each other. And when it doesn't equal, there's a residual or a balancing item. And what this balancing item is the change in reserves, so the change in currency reserves in the rest of the world. Okay, so let's start looking at this pictorially to try and get a basis of understanding and build this analysis out. What we've charted here is the United States balance of payments. And the way this is broken down is we have the capital account charted in red, and we have the opposite of the capital account, or what it's supposed to be is the opposite in theory, is the opposite, the current account balance in blue. And you can see that the capital account is positive and the current account balance is negative. And what's supposed to happen in the balance of payments in theory is that the current account balance and the capital account net each other off. That's in theory. Now, the balancing item, which is in green, is basically the recorded difference between the capital account and the current account balance. So in theory, they're supposed to net each other off. And you can see that the red line is very much pictorially looking like the inverse of the blue line. In theory, they're supposed to net each other off. But when they don't, we have what's called a balancing item. And then the difference plus the balancing item equals 0. Now, the way to look at the balancing item, it's simply the difference between the current account balance and the capital account. And when we think of this in money flow terms, it's basically a change in reserves in the United States. So a change in foreign currency reserves in the United States. Now, the first thing we learn when we look at this is that the current account balance for the US since 1980, so we're charting this from 1980, is negative. So this basically means that the United States is importing a lot more than it's exporting in the current account balance. So this is the exports minus imports number. So they're essentially importing a lot more. But also just remember that this includes the difference between net income from abroad and transfers. So that's also in the equation. And those numbers, or that number, can be positive or negative. But the way to view this, to keep things simple, or as simple as possible, is that if the whole current account balance is negative, it basically means the US is sending $3 to $4 trillion worth of foreign currency reserves more abroad than they are receiving in dollars back. So the difference is a negative dollar value. Now, if you think about this in basic terms, if the US is importing from other countries, they obviously have to pay for those goods and services in foreign currency. So what they're doing is sending foreign currency abroad, but they're calculating for it in US dollar terms. So what's happening is that from 1980 to 2006, the US is a net importer in the current account balance, and they're sending much more foreign currency abroad in dollar terms than they're receiving in dollars. And then since 2006, this position has improved in the current account balance. It's got better, but it's still overall negative. So we're looking at a minus $3 to $4 trillion value that's negative. So negative $3 to $4 trillion is going out relative to what's coming in. So going out to pay for exports versus what's coming in to pay for US imports going abroad. So we get a basis of understanding there by first looking at the current account balance. And we know that in accounting terms, the capital account and current account balance should net each other off. So the capital account should be the inverse of the current account balance. So let's have a look at the capital account and how we work this out. The wider definition of the capital account is basically the summation of foreign purchases of US domestic assets and US domestic purchases of foreign assets. So basically, when a foreign person or company buys a US asset in the United States, they pay for it in dollars. It is recorded as a credit. Money is coming into the United States and into the capital account. And when a US-based person or company buys a foreign asset, they pay for it with foreign currency reserves, so in the foreign currency, and it's recorded as a debit in the capital account. So money is coming out of the United States and out of the capital account. And the difference between the two items, so the current account balance and the capital account, should in theory balance. However, it very rarely does. Now, the balancing item itself is either adding back or taking away a number to make sure that the difference between the current account balance and the capital account is zero. And when you add this back in, we know that the balancing item itself is a change in reserves. When you add that back in, the balancing item itself is the inverse of the change in foreign reserves for the rest of the world. So what is outside of the United States? So we have to think of this in debit and credit terms all the time. The current account balance plus the capital account should equal zero. When it doesn't, this represents a change in reserves in the United States. And the balancing item itself is the inverse of the change in foreign reserves for the rest of the world. So just bear that in mind. This is how we build up our understanding of the debits and credit system. We have to dig into the numbers and really figure it out, because if we get it wrong, we could be completely the wrong side of what we actually want to be doing. So probably the best way to deal with this in terms of understanding the underpinnings of the numbers is probably to go over to the exogenous driver analysis spreadsheet. So if we come out of the presentation and go over to the exogenous spreadsheet, we'll see here that we've got the United States balance of payments going all the way back to 1960, all the way up to 2013. And we get this data from the BEA website, and this is a direct link to get all of the US historical trade data. What you're going to get when you click on that link is an automatic download of all the US trade data going back to 1960. And if you just focus on these numbers here for the moment, you'll see that all of the numbers come from this spreadsheet. and this is the line for 1960. So in your own time, you can go through everything. If we go back over to the exogenous analysis sheet, you can see when we're looking at 1960, we can see the exports and imports number is coming from the US trade data from the BEA. And all of these numbers are accurate from the original spreadsheet. We've just transposed the numbers across and focusing on the items that really matter. So we've created our own bespoke analysis here, so we understand how to dig a little deeper and use these numbers properly, because there's a lot of numbers that are just irrelevant to our decision-making process. So we're starting in the United States, and what we've got is the current account and the capital account, and both of them have a balance. And in theory, these two should actually equal 0. But you can see here on row 18 that every year there seems to be an error. They don't actually equal each other. They don't net each other off. The inverse of this is what needs to be added back in, so it does balance, and that is the balancing item. And the balancing item is essentially the change in US foreign reserves. Now, if you go over to the chart that we looked at in the presentation, so over here, if you first look at the current account balance, we can understand where these numbers are coming from. So you can see that if we click on the current account balance line in the chart, that it's referencing row 10. And this is the current account balance itself in 1960. And we have all the data going up to present day. And if you click on the capital account balance is in row 16. And the balancing item is basically the inverse of the error. So it's the error inverse and has to be added back in. So the current account balance and the capital account balance equal 0. So we want the whole balance of payments to equal 0. So the green line that you see is the balancing item and essentially the change in US foreign reserves. Now, if you go up to the current account balance first, you'll see that overall in 1960 we get a positive number. Well, that means the US is a net exporter of goods. So you can see exports minus imports, and overall becomes a positive number. That means the US is in surplus. So if it's positive, it means that dollars are coming in. More dollars are coming in to the United States. When we look at the capital account, we can see what this is made up of. We can see the change in foreign-owned assets in the United States. And we can see this has gone up. And we can see the change in US-owned assets abroad. And we can see this has gone down. And we can see that this has gone down more than the amount of assets that are being purchased by foreigners in the United States. Now, if the balance is positive, it means more dollars are coming in. If the balance is negative, it means more dollars are going out. And here we have a negative balance. When we add the two together, the error is positive. And to make this equal 0, we have to add back in a negative number. So the balancing item in this circumstance is negative. Okay, so what does this mean overall in terms of money flow? Well, if this number is negative, so the balancing item is negative, or the change in US foreign reserves is negative, what it means is that this number by default must have been positive, which means the United States is in surplus. The US is a net exporter, which means that more US dollars are coming in than going out of the United States. So more US dollars coming in, which means that relative, the rest of the world is reducing their US dollar FX reserves by the same amount. So US dollars abroad in aggregate are depleting by this amount, which means the US dollar is in demand. But if we just take a step back, if this number is positive and the current account balance and the capital account balance are supposed to net each other out, then this number here represents the amount of US dollars coming in. The balancing item is therefore the flip side of that. So it's the change in US foreign reserves. So if an amount of dollars comes in to the United States, so here 1,019 million, if a number comes into the United States in US dollars, this value, then foreign currency reserves fall by this amount in proportion to US dollar value coming in. So the balancing item essentially represents the change in US foreign reserves. So let's just go through this quickly again so we fully understand it and comprehend what's going on here. If this number is positive, the error is positive, it means that more dollars are coming in. This number represents the amount of dollars that are coming in. But it also represents the amount of dollars that the rest of the world's US dollar reserves are going down. Now, if this is coming in, and this is the error between the current account balance and the capital account, so the error is positive, the US is a net exporter, the dollars are coming in by this amount, and the rest of the world is reducing US dollars by this amount, then in the US's own accounts, this number of US dollars has gone up in proportion to foreign reserves within the United States. So the holdings of US foreign reserves have fallen by this amount in proportion to US dollars coming in. So the balancing item basically represents the value or change in value of US foreign reserves and is the opposite of the error between the current account balance and the capital account. So basically, when we think of this in big numbers terms, this number here is the amount of US dollars coming in, therefore $1 trillion coming in to the United States in 1960. And that number represents, again, $1 trillion of US dollar reserves going down by $1 trillion in the rest of the world. So the rest of the world has lost $1 trillion US dollars, and the US dollars, the $1 trillion has come into the United States. And by the United States' own accounts, this means that the change in US foreign reserves in dollar value has gone down in proportion relative to the dollars coming in. Now, if you think of this in reverse, let's think of this in reverse where the error is actually negative. So if we look at column H, for example, so if in column H we have a negative value here, well, this means that there's more dollars being shipped out of the United States. So the US is a net importer. So US dollars going out. And this represents $629 billion going out of the United States in dollar value. And the rest of the world is receiving this $629 billion. And it might be across many different countries, but the rest of the world is receiving $629 billion. So their US dollar reserves are going up in value. The rest of the world is being supplied more US dollars. And in proportion, the US's own foreign reserves, because the US has now lost 629 billion US dollars in value, the US foreign reserves go up in value by the same dollar proportion. So the balancing item is the inverse of the change in foreign reserves for the rest of the world. So when we look at this number, we know that this is the amount of US dollars going out, and the rest of the world is increasing their US dollar FX reserves by this amount. And the balancing item is just the inverse of this. And we can see that here. Again, we can see the opposite, which is US dollars coming in, the rest of the world reducing their US dollar reserves by this amount. And the balancing item is simply the inverse of that. So if we go back over to the presentation, let's just put all this together. So the change in US foreign reserves being negative, this means that the US is running a surplus. So the US is a net exporter, and the rest of the world is shipping US dollars to the US. There's more US dollars coming in. So the rest of the world is reducing their US dollar FX reserves. That by default means that the US dollar is in demand by the rest of the world. So this means we lean towards having a long currency bias. And in the opposite situation, if the change in US foreign reserves is positive, so the balancing item is positive, this means that the US is in deficit. The US is a net importer. The US is shipping out more dollars to the rest of the world, and the rest of the world is increasing their US dollar FX reserves. So if the US is shipping more dollars out, the US dollar is in supply to the rest of the world, which means we have a short currency bias. We lean towards a short currency bias. Now, bear in mind, what we're looking at here is we're looking at the US's own accounts. So we're looking at the US in a static analysis. We're looking at the US in absolute terms. Very similar to the way we looked at things when we were looking and analyzing in our endogenous analysis. So what we're doing here is just building things out. We're moving towards an exogenous situation. Right now, we're looking at the US in an absolute or static way, because we're not actually comparing this change in the US dollars in the US's own accounts relative to another country with their own currency. So we're looking at the US dollar versus the rest of the world. And as alluded to previously, we're looking at the US dollar to the rest of the world, which means this is against every other country in the world. So US dollars being shipped into the United States means the rest of the world has a demand for US dollars. And this can be split up amongst many, many countries. And in the opposite case, US dollars going out, so US dollars being shipped to the rest of the world, this means the rest of the world is increasing their US dollar reserves. But this isn't just one country. This is across the entire world. So it can be across many, many different countries. So we're looking at this as a long currency bias when the rest of the world is reducing their US dollar reserves from an endogenous perspective. And the same, we're looking at a short currency bias when the rest of the world is increasing their US dollar reserves. So when US dollars are in supply, we're looking at a short currency bias from an endogenous perspective. So we're leaning towards this situation, but what we actually have to do is compare the accounts relative to the country that we choose to look at or choose to analyze when we're looking at it from an exogenous perspective. So we have to actually look at the same situation for Australia. So we've looked at the United States versus the rest of the world. Now we have to look at Australia versus the rest of the world and specifically look at the debits and credits or the money flow of the Australian dollar to and from Australia, to and from the rest of the world. And the approach that we take with Australia is exactly the same. We look at Australia on a static absolution principle basis versus the rest of the world. So in an endogenous way, and we continue to build towards our exogenous analysis. And all of the data, the trade data for Australia is available in the spreadsheet. So let's go over to the spreadsheet now. If you go into the exogenous spreadsheet and you click out of balance of payments US and click into balance of payments Australia, you'll see that we have a whole bunch of data here. And the first column, we have in column A, the date, and we're going up again by years. In column B, we have the current account balance for Australia. In column C, we have the capital account. So the capital account in a wider definition, so capital account plus financial account. So we have that balance, and we have the error. So we have the difference between the two. So we have the current account balance plus the financial account. That should equal 0, but it doesn't. It equals 34. And then we have the opposite of that, which is the balancing item. So the balancing item being the inverse of the error as to whether Australia is in surplus or deficit. So where do we actually get all of this data from? Well, this is all coming from Australian trade data. If you go into the sources tab, you'll see here a link to the Australian Bureau of Statistics. If you click on that link, that'll take you to a download area onto the ABS website, and you'll be able to download those stats. What you'll essentially be downloading is a similar analysis or a similar spreadsheet to the one we got when we downloaded the US trade data, where you have all of the trade data going back historically to 1959. And this represents all trade data across the current account balance, the capital account, and the balancing items. So you'll be able to go into that and you'll be able to cut and paste the numbers across. Now, do bear in mind, a lot of the time this can be a little bit tricky because you have to play around with quarterly and annual data, but also you have to sometimes flip the data from being available horizontally to vertically. So it's all pretty straightforward. If you want to learn how to do that with Excel, there's plenty of free resources online. Now, if you take the items that are actually relevant to our analysis, what we really want is the current account balance, the capital account balance, the error, so the capital account balance plus the current account balance, and the inverse of the error, which is the balancing item. So we work that out ourselves. What we also have here is the annual change in the Aussie dollar US dollar exchange rate, and we all going back to 1974, and we also have, going back to 1974, the annual percentage change in the Aussie dollar US dollar exchange rate. And you can see here we're looking at obviously a very long time frame in trading terms. We're looking at essentially 1 year volatility. And if we look at the chart on the right hand side in the same way that we looked at the US data, we can see here that if we're clicking on the blue line, we are referencing the current account balance data. If we click on the red line, we are referencing the capital account data. And these two, if you recall, are supposed to net each other off to 0. So what we would expect to see if we were looking at our balancing item when we looked at the United States is the difference, or the sum of the two. And the sum of the two should actually net each other off. But what we've done here is not referenced the balancing item. We've referenced the Aussie dollar US dollar exchange rate. And you can see that the Aussie dollar US dollar exchange rate actually follows what we would expect to see in terms of the trend of a balancing item. Now that's quite interesting, because what we're actually doing here is only looking at the Australian dollar accounts. We're not looking at Australian and looking at United States and putting them both on the same chart. What we're doing is just looking at the Australian accounts and charting the Australian accounts, so the current account balance and the capital account, and looking at it pictorially against the Aussie dollar US dollar exchange rate. So we're looking at really a dynamic number, the Aussie dollar US dollar exchange rate, relative to a static number, a static situation. So the Aussie dollar US dollar exchange rate, if you recall, you can't buy a currency without selling another one. So this is a dynamic number. And the snapshot of the Australian trade data in the current account balance and the capital account balance is endogenous. It's a static snapshot. We're not comparing this in any way to the United States. And it's quite interesting that the Aussie dollar US dollar exchange rate, which is charted on the right hand side, the value is on the right hand axis. we're looking at the annual change, and this kind of represents a balancing item. Now, if we actually look at the Aussie dollar US dollar exchange rate relative to the balancing item, so if we compare it to the balancing item, you'll be looking at this chart here on the right hand side. And what we've got here is, on the right hand side, the Aussie dollar US dollar exchange rate versus the change in foreign Australian reserves, so versus the balancing item. If we click on that, you'll see we're referencing column E, the change in the balancing item. So on the left hand side, we have the scale of minus to plus 2 trillion, and this is going back to 1980, and you can see that they kind of do follow each other, but there's anomalies. So you can see here, for example, that in the early noughties, it can actually look like the opposite, and here in the mid-90s. But you can see that sometimes it's following each other. So like in the mid-80s and also the late noughties and early teenies. So it doesn't look intuitive at first. Well, that's because we're looking at the Aussie dollar US dollar on the chart, and we're comparing it only to the Australian trade data. So Aussie dollar US dollar is a dynamic statistic, and the Australian trade accounts are obviously a static or absolute statistic. We're not comparing that data to the United States. So let's remind ourselves of exactly what's going on here. We have done a bit more further analysis when we've looked at the Australian trade data by comparing it to the exchange rate than we did versus the United States trade data. That's so we can move on later to looking at the Aussie dollar US dollar exchange rate relative to both the Australian and US trade data, which means we can actually look at a dynamic versus dynamic analysis. And we're going to be linking all of that together in a moment. But let's have a look and remind ourselves of what's going on with the Australian trade data. The Australian trade data we treat in exactly the same way as the US trade data. So if we have a change in Australian foreign reserves that's negative, so in column E we have a negative number, that basically means we have a positive number in column D. So the error is positive for the current account balance plus the capital account balance. That means that Australia is in surplus. So Australia is a net exporter. That means Australian dollars are coming in to Australia, and the rest of the world is reducing their Aussie dollar reserves, which by default means that the Australian dollar across the world is in demand. So we lean towards a static long currency bias. If we look at the opposite situation, if the change in Australian foreign reserves is positive, so this number in column E is positive, what does that mean? Well, it means that the number in column D, the current account balance plus capital account, is negative. And this means that Australia is in deficit. They are a net importer. This means Australian dollars are going out of Australia, and the rest of the world is increasing their Australian dollar reserves. So the Australian dollar is in supply to the rest of the world. And from a static perspective, this gives us a default short currency bias. Now, as mentioned, this is obviously the same analysis as we've applied to the United States.